And I love the fact that you came to in the charts and you immediately cheated and brought 3 charts.
Oh,
So,
sorry. Yeah. Like a true vet, you know?
like a true veteran. Welcome to In the Charts, everyone. Today, for the first time ever, we have an invited guest. Today, we have James, which is general counsel and really does everything and many hats at Hon Ventures. So we're very excited to have him sharing the first chart with us. So
I'm super
James, let's
thrilled to be
go.
on. This is awesome.
Yeah, let's go right into it. I'm gonna start by sharing your chart, and you're gonna tell us what you brought.
Yeah. So this is from a forthcoming paper in NYU Law Review called No Exit, which I thought was a really funny title. The thrust of the paper is really about kind of the current antitrust environment and how that has really changed M&A activity and venture capital exit opportunities and kind of created some distortionary effects. But I thought this was an incredibly striking chart, like right in the middle of the paper, which basically shows on the left side, everything pre-2001, that this is the percentage of venture capital exits that were IPO versus M&A. And you basically see this complete reversal from post-dot-com bust, where for the past 20 years, almost all volume-weighted exit opportunities in venture capital have been M&A activity. And then if you go to the next chart, you see something a little bit of a different picture, which is that when you do dollar weighted, you actually have a shift towards very large IPOs. And so the third chart kind of really makes this crystal clear. This is actually from a different researcher. If you want to flip to the third chart. So this is Jay Ritter at University of Florida. He does a lot of research into IPOs, but basically what's going on is that the IPO window for small firms has basically been more or less shuttered for going on 20 years now. And so this creates a lot of kind of very interesting questions as the NYU paper outlines, which is what is the potential exit opportunity when already the IPO window has closed for sub TTM of 100 firms with TTM of less than $100 million for the past 20 years. That has shifted to M&A, and now with M&A antitrust scrutiny, there's like a big open question as to kind of what the future of exit opportunities look like, which is why you get these weirdo, Meta, Scale AI, reverse acqui-hire situations, which is why you get these Microsoft mega partnerships with OpenAI, which are kind of basically creating like these weird other ways of creating exit like opportunities in the absence of an IPO or M&A activity.
First of all, how fitting of James to bring us charts from an NYU law paper. I just want to point that out. We know James very well, and obviously this is par for the course.
On brand. This is definitely
totally,
on brand.
Totally. I think this is super interesting. I mean, first of all, I think this is laying out in data, I think, what a lot of folks have been actually talking about for a couple of years now, where there's been a lack of liquidity for venture companies generally over the last couple of years, mainly caused by two things. Number one, the IPO window has been shut. And then number two, M&A has been historically, compared to history, very challenged because of an administration that was very anti-M&A. And it seems like that's opening up a little bit, right? So some of the recent IPOs that have performed very, very well, CoreWeave and Circle, both have performed, at least in the short term today, very, very well, which kind of shows the pent-up demand for either AI and crypto or just new IPOs in general. So there's some type of pent-up demand there. And then we've also, at least in the world of crypto, seen more M&A activity in the last year than we have really in the past 5 years, probably combined. So it seems to be turning around a bit, but it's so important to have these exits especially because companies are staying private for longer, and there's now more capital that allows companies to stay private for longer. So if it is true that, generally the smaller quote unquote exits tend to come from M&A, it's really important that that exit path remains open.
Yeah. And the interesting thing is that at the conclusion of the paper, the authors basically leave it as an open question. NVCA has been really on this I think they have some statement of, the venture capital dance is, it seems like we're in a, very kind of tenuous position where the market seems to be breaking. I think the authors leave it very much as an open question as to, whether these sorts of effects, whether, with continuation funds, with tender offers, with other kind of liquidity opportunities, you can't, I mean, the markets are constantly evolving. It doesn't have to be IPO or M&A. It could be, uh, there's an entire spectrum of interesting exit opportunities and liquidity opportunities. And I think you're seeing the same thing in the capital formation space. We've been talking a lot about on-chain IPOs, alternatives to basically what has been, Reg D and public markets dominated capital formation again for the past 20 years. And I think we're starting to see an opening up and kind of more creativity happening in that space as well.
Yeah, I think the analogy that they used was pretty fun was venture capital without M&A and IPOs. It's like dancing without music. You can do
Yes.
it, but it doesn't make much sense.
Yes. Yeah. That's what that was the NVCA quote. Yeah.
That was a pretty good quote.
Yeah.
Awesome. There was also they talked about perverse incentives, right? So with the continuation funds and all these things, there were perverse incentives. And in fact, I think the stated purpose of not allowing these concentrated bets in the large companies to aggregate were, if I remember correctly, James, I think you know more, but they were talking about perverse incentives, that this didn't actually meet the objective of the policymakers in the first place.
Right. That's exactly right. Is that if the goal is to ensure that there isn't kind of collaboration in the marketplace among erstwhile competitors, and you're trying to kind of actually foster innovation, probably what you want more of is, you know, uh, you want a set of policies that isn't so focused on kind of strict exits and outcomes. You want kind of policies that are much more focused on the kind of top of the funnel, and again, thinking about capital formation, thinking about small firms that are sub 100 million TTM, having a plethora of different financing and exit opportunities to ensure that you can kind of preserve competition rather than going in with a blunt hammer on the back end and saying, no, you can't merge, and then you just kind of create end runs around the system instead.
That makes sense. Awesome. And I love the fact that you came to in the charts and you immediately cheated and brought 3 charts. So
Oh, sorry. Yeah.
Like a true vet,
like a true veteran. Chris, you're up next. What did you bring us today?
Oh, I've got everybody's favorite topic, which is, are we in a bull run? And so I want to talk about this. So what you see here is just a very simple indexed performance chart of the NASDAQ and the S&P 500 over the last 5 years. So on this side is indexed to, 5 years ago in 2020, June of 2020. This is today. And as you can see, I've appropriately named this all-time highs for both of them. We see the S&P 500. I mean, they're also at all-time highs, but underperforming the NASDAQ by a little bit over the last 5 years. But I wanted to bring this because I think this is a very confusing and counterintuitive chart for many. I think if you were to read what is in the headlines of the news, I think what you hear about are wars and the potential brink of being in a world war. You hear of Fed not cutting interest rates because of continued fear of maybe reinvigorated inflation. I think the market will disagree clearly on that, but what you hear in the news, I think, points a very, very sour picture for a lot of stability and its implications for global economics. And what the market is telling you is actually the complete opposite, which is things have never been better. Quite literally, we're at all-time highs. And of course, I will cheat also and bring you the second chart, which will overlay the exact same chart that you saw relative to Bitcoin price over the last 5 years. And what used to be a chart that was up and to the right for the S&P 500 and NASDAQ looks like literally a flat line compared to Bitcoin's performance. And so even in crypto, where actually the sentiment, I'd say, is still pretty negative, apart from a couple of different areas. One of them is Bitcoin, another one is stable coins, maybe a third is tokenized assets. And I think broadly, though, folks that have been focused on the proliferation of tokens, memes, etc., I think have felt really negative sentiment. But actually what this chart shows you empirically is that we're kind of in a bull run, even though I don't think we talk about it like that, or even if it doesn't feel like that. So I want to leave this on here. I'm curious for your guys' reaction to this. Are we in one? Are we not? Does it just look different this time? Is this just the start of something? Are we actually at a peak and we just don't realize it?
I think we have a little bit of the benefit of the fact that we obviously talk about this topic all the time, including every week on our team meetings, multiple times a day, in fact. And I think the main thing for us crypto investors is that for the last few cycles, we've always had the most interesting stuff happening in crypto has not been Bitcoin. It is interesting, of course, but it doesn't do much. And so most of the interesting stuff and like the future of the internet and the decentralized smart contract platforms that are doing really cool stuff are happening outside. And we have spent a disproportionate amount of our time in our analysis and pitches, like listening to what the future is that the amazing founders are building. And it feels right now to us that obviously the altcoins and everything else other than Bitcoin is not really in a bull market. I think that's pretty fair to say. Nothing is hitting all-time highs. And so I think that is really the way that I feel. And part of the reason why I think there's a malaise in crypto around this is not clearly a bull market is because Bitcoin dominance is essentially at an all-time high over the past, 7 years, 10 years, when compared to the altcoins. And all the stuff that founders are doing and they're building, those are not being valued by the market as they are valuing Bitcoin. And so that's, I think, why this is a tale of two worlds. The public market's all-time high, Bitcoin all-time high, and we somehow still feel like this is not a bull market for us.
And it's also large cap. I mean, even the public markets, that's a large cap all-time high, reflecting, shift towards, passive investing trends, ETFs, and that's probably corroborated in the crypto markets in a pretty parallel fashion, right?
Yeah, I feel like we're in like a little bit of a paradoxical market. Like on the one hand, you have all the signs of bull market, right? You've got like public investing fervor and leveraged crypto with all the treasury companies. You've got a new crypto IPO. We're near all-time highs, but at the same time, qualitatively, it doesn't feel like it because I don't have the like random friends from college that I haven't seen literally since college ask me if I should buy Bitcoin. I don't have my great aunt ask me if I should buy Bitcoin. And maybe that's just a sign of like maturity in the ecosystem, people just are established. They've already done that. They've for
Your
for better or
grandmother has
worse,
already bought
they
Bitcoin.
yeah, she's already a hodler, she's holding on for dear life. And so maybe the qualitative measures are different on an ongoing basis. I don't know.
Yeah,
But it does
those are
feel like we're in
interesting.
a little bit of a superposition between the
Yeah.
quantitative metrics and like what we feel.
The other thing that it made me think about is actually the things that are punching through in crypto right now are the things that are that simple to understand. Bitcoin is very, very simple to understand. It's, digital gold is the easiest thing that you can explain to somebody. And I think stable coins are also very, very easy for somebody to understand. It's just a digital dollar. And those ideas are punching through way more than when you have to explain why a new L1 that is faster in some way, has a better consensus mechanism in another way, or is more decentralized, etc., is better and superior than the current alternative. And so, I think this is also the mainstream attention, frankly, remains on AI and likely will be so for the foreseeable future. And so the simpler your messaging, the way that you can punch through is just simple one sentence explanation of what you do and why it's important.
Yeah, I mean, the other thing is I think we're used to having a little bit of main character syndrome, right? We want Bitcoin and crypto to feel like the topic du jour, and it doesn't feel like that today. We're being overshadowed by other geopolitical events, the market broadly, and other tech things like AI. And so maybe that's another part of the reason of why it doesn't qualitatively feel like we're in a bull market is because we're not the main character this time around.
That's amazing. Breck does not like not being the main character. And for now, let's put you as the main character. Show
All
us your
right.
chart.
Yeah, let me share my screen. Okay. As the resident Gen Z, I felt like I needed to make myself the main character, as Diego just said. And I was thinking a lot about like generational trends in the way that we interact with finance. And this chart kind of like very clearly shows people who use like traditional brokerages versus using fintechs only, so like technology platforms, and then somewhere in between. And you can see across Boomer, Gen X, Millennials, and Gen Z a pretty clear shift in less traditional brokerage and more usage of fintechs to invest in the market. And I think it's pertinent for a couple of reasons. The first is that I actually thought brokerages would be a lot lower. Like, it's clear that they're still like fairly dominant, the traditional model. But second, Gen Z's spending power is about to like 25x in the next 5 years. So one of the largest generational transfers of wealth is going to happen. Right now, people are calling Gen Z's spending power something around like 500 billion. But the expectation is by 2030, it'll be north of 12 trillion bucks. And so the feeling of platform shifts that go across generations is going to be felt a lot more powerfully in the next 5 years as Gen Z becomes the most, like, the wealthiest class of people on earth. And as investors, I think the question begs, like, what does that mean for us? Robinhood is probably the most used platform for investing in fintechs, but it wasn't built for Gen Z. You know, like what Vlad did is mostly for millennials and coincided with the platform shift to mobile. And I have to imagine there will be opportunity for folks to build a Gen Z investing or financial services application that is built for Gen Zs that will coincide with some of the like tailwinds that we feel in digital assets and prediction markets, and like the relationship between social and financial services, and also, you know, probably will have something to do with AI. And I feel like it's a pretty damn big opportunity. And, you know, we've talked about this a little bit within the investment team related to some of the meme coin stuff. I think the observation being that, like, not Gen Z, but Gen Alpha, a lot of people who are still in high school or maybe in college, their first dollar earned on the internet is probably through investing in a meme coin, or maybe through like some digital collectible in a Roblox game or something. And that probably also has profound impacts in the way that you engage with financial services. You know, I can't imagine someone earning 10,000 bucks on Fartcoin or something and then walking into a Bank of America. And so what are the right places for us to pay attention to? You know, where will there be opportunities for new entrants to come in and, you know, dethrone a Robinhood, or, you know, maybe it's a Phantom, but I have to imagine there's some, you know, fertile ground here for people to build. And I figure we should talk about it.
It strikes me how high the traditional is among Gen Z. That's very surprising to me. Yeah, I would have
Not to
expected it to
imagine
be
it's
kind of
like,
yeah.
not to imagine it's like my parents were like, Breck, as
We're
soon as
gonna
you
set you
graduate
up
from
a Schwab
college.
account.
Yeah,
Yeah,
exactly. You need a Fidelity,
yeah,
you need a Schwab, you need a 401k, and like it's a little bit of a relic.
yeah,
But maybe the next time, like for Gen Alpha, it looks different.
yeah, for sure.
Yeah.
I think empirically, we talked about it last time. I have started hearing anecdotal evidence of, you know, 21-year-olds, 23-year-olds that have no bank accounts, but have crypto wallets and have cards and have everything. And that is so cool. For me, this data does not represent the empirical of what I feel happening. And so I would love to see this chart and specifically talk about like crypto wallets, people that don't have, I want to set people that don't have traditional accounts, but have a crypto wallet and are getting all their services from like crypto neobanks. That's actually like a really cool insight, I think, for us that would be really interesting. Empirically, this is happening, and it's going to happen because, like you're saying, the first thing that you're going to interact with is going to be something that is memeable because you're on Roblox and you're going to get some Roblox bucks, and that is a cryptocurrency. And so you have a wallet and you are 8 or 6 and now you have a wallet, and you cannot be, you need to be 18 years old to open a bank account. And so you're going to have 10 years of using crypto wallets and these things until you actually get to the ability of opening a bank account. So necessarily what I feel like is, as our space succeeds, like this has to change. And so I would expect this to be actually like much more, that blue bar should be much higher in my estimation.
Yeah. And then I think the other thing that's worth talking about here is why, like, what is the advantage of the fintech over the traditional broker? Like, why is that blue bar bigger amongst younger generations? And I think one of the key things is the user experience that people desire is for money to move at the speed of everything else that they're used to with apps and the on-demand economy. Like today, I can order a car and it arrives at my doorstep in 3 minutes. And yet, if I want to send a little bit of money to somebody else, it's a pretty convoluted, painful process with no, like, you would expect that there's now like a loading screen that comes up and says, oh, like it's still 100%, your money is sent, and you get a confirmation. You try to send a wire, it's like, I don't know where it went. Hopefully it arrived safely. And so that's the experience. And a lot of, I think, what folks in crypto are building is solving for that. I'd say the other overlay to your point, Diogo, is that today these fintechs don't have all the products that you can get through a traditional brokerage, right? So, and that's changing pretty quickly, right? Recently, Robinhood, I think, is helping to provide even mortgages through partners. And so soon, I think you'll be able to get all of the functionality that you would ever want from a brokerage in a fintech. And there'll be numerous of these examples.
Yeah. The other interesting thing also is that was the same story with Schwab, right? That's how Schwab built its business, was by offering a better user experience, lower fees,
Cheaper
discount
pricing, yeah.
brokerage. And it's just like natural creative destruction that the next generation would have their version of Schwab, which would be even better and, better user experience, more convenient, faster.
Yeah,
My expectation was that something like Robinhood would have way more penetration. So at least the reg should be much, much, much higher. That was sort of my first instinct when I looked at this graph. And so, turns out like I'm wrong, and kind of like we live in a bubble and everybody around us has a Robinhood account, but that's not the same thing for everybody in the US.
Yeah. I was also trying to ask myself, like, are the existing fintechs the ones who have the right to win? Like, does Robinhood just have a now compounding advantage and they can continue to exploit that for subsequent generations? Or does there need to be a new version of Robinhood for Gen Z and Gen Alpha? Or like, is there a distribution advantage? Like right now, like I think the way that a lot of people, like one of the main differences between Gen Z and millennials is like, I go on TikTok to buy the meme stocks of the day. I go on Reddit, like it's very social in nature versus like being single player. And we've seen announcements recently where X wants to be the like everything app, right? And they want to embed trading. They've already done payments, but they want to embed trading natively into the app. Like, are we going to see a shift where existing incumbent social platforms are going to try and be the fintechs of, the future? Or is there going to be an opportunity for a new fintech to arise that feels more social? Who knows? But I think that's that'll be one of the key questions.
Yeah, we should vote on it. I would bet on distribution winning, because this crop of companies like Robinhood, like Stripe, are doing all the right moves. Buying Privy, buying Bridge, going on chain, issuing stable coins. Robinhood is part of the USDG. They're doing all the right moves. We're not seeing this kind of like innovator's dilemma where they're just not going into the new thing, because they themselves are still challengers and they still have so much pain and they want to innovate, but the traditional financial industry doesn't allow them. So they're looking at this as optionality. And so they're adopting these technologies much, much faster than you'd expect an incumbent to. And so distribution just wins any day. That'll be my vote.
So Diogo votes for TikTok Trade.
TikTok Trade. Actually, somebody told me something really interesting. They have a business where their target audience is people with over $1 million in AUM and in assets. And so kind of like, obviously like millionaires. That's not a big percentage of the population. And they were finding them on TikTok. They actually had to go to a market that was working on TikTok. And I was just like mind blown. It's like you go on TikTok and you actually get millionaire clients. And that was like an interesting stat.
Well, yeah, and that's the thing with Gen Z. It's like it's going to be the richest generation, but also the most unemployed generation. Like that's like seriously, like that's
all
the
they
paradox.
have to do is trade.
That's like if you look at any of these reports, it's literally like they're the most online. They're having the hardest time being employed, but they're going to be the richest part of the population in 5 years.
It's
and
funny,
that's like kind of a
yeah.
conundrum. That's going to change consumer behavior.
So speaking of generations and speaking of changing consumer behavior, it's kind of funny. We didn't coordinate this, but this is the chart that I brought to you today, kind of like off of the cuff. And it literally is a chart of ages 65 and over as a percentage of employed. And so on the y-axis, you have the percentage of folks over 65 that are employed in the workforce. And on the x-axis, you have time. And I do want to make a point, which is in 2011, the last boomer became 65 years old. And so in 2011 was like the age after which these people are all 65 years old, the boomer generation. And I think this chart is actually pretty interesting. And I do think it leads to some interesting demographic questions. The first thing that I noticed that I thought about, well, number one, what the chart is saying is at the lowest peak, only 2.5 to 2.7% of folks over 65 and over were employed. That was the lowest since 1945. And now we actually are seeing 7% plus of over 65, folks over 65 that are employed. So the obvious one is we're living longer, we're healthier, and so we can work. So this naturally should actually tend to go up. That's fine, except that the trend over the past few decades wasn't that. And so, there's at least some amount of like explanation they need to do either backwards or forwards. The second thing that is interesting here is from a productivity perspective, I feel like I haven't seen people talk about this narrative as one of the things that is going to help the economy boom, because obviously we're a more productive workforce. The folks over 65 are not just retiring. A bigger percentage of them is actually just continue to working into later and later. And then obviously that has implications for the earlier workforce, which is, are these jobs that should have been open for the Gen Z? So is Gen Z not working, like Breck was saying, because they don't want to, or because they don't have the opportunity, because there's an all-time high of boomers actually keeping those jobs. So this is the chart that I brought for you guys.
What's interesting is that actually here, you don't really see that big of a dip in COVID. And I think if you were to overlay this on top of just generally, I think, I would have thought that the older you are, right, when COVID hits and the world shuts down, it's a pretty natural time for you to say, you know what, I'm going to hang up my cleats and I'm going to call it a day. And I think it kind of shows to you the type of mentality that boomers have around employment. And I think this kind of gets to
wait, Chris.
Yeah.
Let's run through that.
Yeah.
My feeling, and I'm not a boomer, but I think like one. Generally, I didn't realize the world was this unsafe. I didn't realize that the world could all of a sudden, my savings could go down by 40% in one day, and we could be locked down, and the world is this dangerous. I need to continue working because I don't feel safe with my retirement. I don't feel safe with the position that I'm in. So my instinct was the opposite. It was I need to work harder. I need more gigs. I need more diversification. And so a boomer is probably likely thinking like I am.
That's fair. I hadn't thought about that. It would have highly been dependent on what their assets were tied up in, right? I mean, I would have assumed if you hit age 65 in 2011, hopefully by that time, you've exited equities for the most part, and you're in some safer stuff like bonds or something because you're in wealth preservation mode rather than I'm in wealth gaining mode. But I don't know. It's possible, right, that you see 30% of your portfolio that was in stocks, all of a sudden get halved or something, and that feels scary. I was just thinking about the TikTok meme where you've got, the worker who gets an email at 7 a.m. and you're the boomer with the coffee and you're like, oh, what a great day. I get to start my work. And then it fast forwards to a millennial who's I hate my boss. And then the Gen Z who flat out just ignores the email and doesn't even respond to it. And I think there's
Just
a
lying
cultural
on the
change there
ground,
too. Exactly.
Yeah.
That I was thinking about, just maybe because Breck had brought up the previous chart. But that's the thing that I noticed is in 2020, I would have imagined there's a good portion of people where it was a very natural time for them to say, you know what, this is a great time for me to exit the workforce. And it doesn't seem like that was the case.
Not to add the political overlay, but that also very much matches what we're seeing at kind of leadership level. We just saw with the New York election, there does seem to be all of a sudden this very strong tension between boomers, older generation who have not wanted to retire, who have remained in leadership roles longer and longer. And we have many, many octogenarian politicians now and millennials who are trying to, for the first time, really step in and take these leadership roles, and what happens when those come head to head.
This is crazy stat. I don't know how to think about this. I'm my head's kind of swirling. I'm thinking, are we just seeing the baby boomer generation from 2000 to 2020? Are we just seeing that stat show up? Obviously the American population boomed post World War, and so that's when 2000 is kind of the inflection point. That's when they're turning their late 50s. And so are we just seeing that, or are we seeing something different? Are we seeing longevity happening where people just 75 is the new 65 and people are just staying in the workforce longer? Or are we seeing something else? I honestly I don't know enough, but this is really, really interesting.
I think the positive view here is exactly that. 65 is a new 45. You're very much expected to be employed. And at some point, I think we can expect this to be, close to whatever peak employment is on a working population. And 65 will just be you live to 200. You're not going to stop working at 65, right? You're still a teenager. And I hope that that's actually the path. And that's actually what's demonstrating is that people are getting healthier. But I do think that this actually bodes extremely well, not for the demographic, tension, but for productivity in general as a population. At least I hope that that's actually, it's important, right? Maybe the multiplier of AI, right? I would rather have everyone working. Everyone should be working. Yeah.
There's
Yeah,
two
so
sides to
that's
that coin.
it's
though.
also a
I'd
question
rather
of,
have more
is there
young people
replacement
working
effect
than more
here?
old
Is
people
this just
working.
net? Is
Personally,
this just
people that
growth,
are
or
native
is
to some of the
this
technologies.
like
Yeah,
right?
yeah,
Like
fair.
what is the millennial and
Or,
Gen Z
but everyone might.
unemployment rate look
But
like?
everyone might.
Well, we have to bring some boomers to the podcast sometime, and so we can ask them these questions directly. Awesome, guys. This is an amazing edition. Our first guest, James. Thank you so much for joining us and for bringing us such a great chart. So
This was
thank
so
you,
awesome.
everyone.
Great to have you,
guys.
James.
Yeah, see you next week, guys.
Thank you, James.
See y'all. Bye.